Good morning, my name is Terence Sibiya. I'm with Nedbank, Nedbank Corporate Investment Banking. I look after what's called client coverage, which encompasses a lot of the investment banking product, as well as the corporate bank and the big client, key client relationships of the bank. In that mix, obviously, then are clients that are largely based in South Africa, or clients that are also doing a lot of investment on the rest of the African continent. So my perspective this morning will be mostly from the banking lens as an institution, as a financial institution. And in conjunction then, we also do work with other financial institutions which my colleagues and indeed the floor represent.
Good morning. This is a great example of a development agency and a bank working together, sharing the mic here. So very briefly, I lead a group within the U.S. Agency for International Development called the Africa Private Capital Group. Briefly, we have three main focuses with an overall mandate to unlock commercially driven private sector capital into development-related transactions. The first area of concentration is transactions, so working with investors directly on transactions to find what the gaps are and what we can do as an sub-Saharan Africa-wide to facilitate those transactions. The second area of focus is municipal finance, how we can work to create access to capital for those municipalities that are trying to meet the burdens of urbanization through bond issuances or straight debt. And then lastly, and most relevant to this panel and to this group of people here, is we've created a partnership with the Department for International Development, or DFID, through the UK, on trying to unlock South African pension fund capital to the rest of the region. And I think that we can discuss that a little bit more later in the panel, but it's very clear that with $320 billion under management, thereabouts, and regulation that allows for 5% over the 25% cap to the sub-Saharan Africa region, it's a great opportunity if we can all partner together to move the needle a little bit, would be a huge development impact.
Good morning. My name is Mark Mandaba. I'm heading the Timmies Energy, which is the project development company of Abraj Group. Abraj is a $10 billion equity platform specialized in emerging markets, Latin America, Africa, Middle East, and South Asia. Out of this $10 billion, around 1/3 is raised from institutional investors. And this is definitely a pocket we want to tap in and raise more capital. So we have some experience, and as much as at the moment there is a slowdown in the Western economies, it's still a bit challenging to attract institutional investors in this region for this type of assets. So we'll discuss this after. Thank you.
Adamasu Tadessa is my name. I run PTA Bank. PTA Bank is a development finance institution, as you've heard our colleague from EIB mention. We're a little bit different from many of the others in that we're what we call a third generation DFI. We're set up in the 80s. We're very commercially orientated. We were set up to actually be different from some of the others. Very similar to IFC and Afri-Exim. We do a combination of trade finance and infrastructure development finance, as well as SME finance. And we do mostly debt, but we do a little bit of equity as well. Our geographic scope is Eastern and Southern Africa, but it's the expanded scope of Eastern Africa, which means also Egypt and Ethiopia, as well as the East African community. And we go all the way down to Zimbabwe, Mozambique, Mauritius, and so on. We are a hybrid. We're led by public sector shareholding, but we also have private sector shareholding. And that's one of the innovations we've introduced recently. So when we talk about mobilization of private capital, we are an embodiment of that. We're one of the very few multilaterals that's actually a public-private partnership in the sense that we have a mix of shareholding. we pay dividends, and we have market-orientated shareholding structures as well.
Good morning. My name is Nigel Drew. I am a project finance partner at the international law firm DLA Piper. I head the energy and infrastructure finance team in London, and about 80%, I would say, of our work is on projects, either power projects or oil and gas projects around Africa, which is just the way in which the market is working at the moment. Thank you.
Okay, so maybe I can start with a round of questions. And I'll start with you, Terence. Given that you're with Nedbank, and Nedbank is regularly in the market, both seeking and arranging transactions, how would you characterize the infrastructure investment climate for long-term institutional investors seeking to enter this asset class?
Thank you. I think from the perspective of Nedbank, maybe it'd be useful to also give some context, because I also don't sit here just on behalf of Nedbank, but many of you will know that we have an alliance with EcoBank, and together with EcoBank, our coverage of the continent then spans 39 countries. And the reason I say that is because our pipeline, therefore, is quite strong, and it'll give us some kind of framework against which we can answer your question in terms of what we see out there, the project's landscape in particular. From a bank's point of view, I think what we're seeing is that institutions, particularly those institutions characterized by pension funds, asset managers, some hedge funds, chasing longer-term yield, are still having a lot of appetite, and in particular because the deals, as you mentioned in your opening remarks, tend to be longer dated and tend to be quite protracted. And so some of the investment criteria that guides, or the mandates that guides institutions, asset managers and pension funds in particular, tend to look for that longer dated leg of these projects, or longer dated funding of these projects, wherein banks, mine included, would typically participate in the shorter end of the project, or shorter end of the funding of the project, and price it accordingly. So we are typically seeing projects being structured along PPP lines, where institutions chasing yield and chasing yields on behalf of their underlying funds on the longer dated end, and banks playing in the shorter end. Having applied a few filters in the past 6 to 8 months of the live projects, or summary of the projects that we see per sector, from a bank's point of view, what we're seeing is that transport is still largely dominating. In 13 countries that we analyzed in a report that we have compiled, we found that in particular transport, followed by power, mining, some projects still in social and defense sector. Oil and gas, for obvious reasons, seems to have tapered off given the volatility in the oil price. And then we're seeing the emergence of a new class of potential investment opportunity in the water sector. So we're coming across a few desalination plants, we're coming across a few water purification projects, which many are state-driven or public-private partnerships, but largely against the backdrop of state guarantees, or state, including DFIs, as well as local funding institutions being packaged in that particular way. From the bank's point of view, that is the investment client we're seeing. You have already touched upon what would typically attract the bank is a solid investment climate, in particular the regulatory framework, and particular to banks with the emergence of Basel III and its implications, or application and implications incumbent upon banks globally. We're finding that it's becoming a little bit expensive to price some of the projects, given the fact that we have much higher net stable funding ratio, liquidity capital ratio requirements upon us, and indeed a heck of a lot of governance around also how money moves in terms of anti-money laundering has made it a little bit more difficult, or it's made it a little bit tougher, and therefore a little bit pricier for the banks to participate in some of these projects. I think in summary, that's what we're seeing in terms of the climate, in terms of the project landscape. Still very big appetite, but the pricing of the deals has definitely changed upward with some upward pricing pressure.
Thanks very much, Terence.
Doing business in Africa. You can't afford to be without Africa Investor.